Welcome back. We're now going to get into a conversation when it comes to the banking and financial pack and so many of the factors that we continue to closely track over there as well. We've got Sunil Mehta joining us on this to talk us through some of the some of what he's been noticing in the space as well. So we'll welcome him in from IBA to discuss that with us. And we'll also, of course, take that discussion forward with take that discussion forward as well. So along with Mr. Mehta, we also have Sri Kartik joining us, research analyst at Investec. So gentlemen, thank you both for being with us, and to run us through really so many factors that we're tracking right now, from moratorium, NPA pain, implications of privatization and so forth. Mr. Mehta, let me start off with you. Now, reports are indicating that moratorium levels among banks actually seem to be coming down. And some banks have actually been very low from the start. So, why then are we still continuing to see these large fundraisers from big players? Are they cushioning themselves? There's still a slight question mark in everyone's mind around that.
So there are three issues. One thing is a reduction in the moratorium with the banking system. So you are pretty well aware that lockdown 1, so unlock 1, then the unlock 2 has already started. And the government has already divided the entire zones into the green zone, orange zone, and the red zone. And especially activities into the green zone are almost into the full swing. So that is rural areas and the semi-urban areas, their activities are going on the full swing. Now the construction activity has also been permitted and the infrastructure sector has also started. So a large chunk of the economy is coming back to the normalcy. And that's why when the cash flows have started, the moratorium levels are also going down. As regards fundraise by the banking system, so fundraising by banking system is basically for 2-3 basic purposes. One thing is the entire system is anticipating a very good growth opportunities post this problem is over, because every problem is going to come to an end. It's not that this pandemic is going to last forever. Maybe the vaccines, when they are into the market, maybe 3 months from now or 2 months from now or 6 months from now, the problem will definitely be back to the normalcy. So once the vaccines are there, adequately available in the market, protections are available, the economy is going to bounce back to the normalcy. And when it is going to be bounced back to the normalcy, it will have a multiplier effect, because whatsoever demands were postponed during this time of lockdown, in this time of pandemic, they are all bound to come back. Like a lot of marriages are not being organized during this period. So the moment things come back to normalcy, all those events will be reorganized. A lot of other activities which are just being postponed because of the pandemic, they will also come back. So rather the comeback will be at a much faster pace than the slowdown pace. So that comeback stage, I think the banking system is gearing up to mobilize resources, and it is a very good time to mobilize resources because overall internationally the investment climate is very weak. People do not foresee a very positivity into the environment. So this is a time the funds will be available at a much lower cost. So this is a time where people do not have much of the alternative investment avenues. So the banking sector can easily mobilize this opportunity, can raise resources, which will give them the balance sheet strength also, a capability to grow when the time comes back to the normalcy. And then definitely if there is some impact of the pandemic on asset downgradation, that can also be taken care of. So I think it's the entire scenario is totally in sync with the financial ecosystem.
Kartik, while the news on the moratorium front, which we've got, let's say from an SBI cards or somebody like HDFC Bank, is very, very heartening. But what really could be the reason why the moratorium numbers are becoming better? I mean, it's great news, but I'm curious to understand that nothing has changed between May and now in terms of an economic activity. If at all, some plants are operating at 50% capacity, some plants are operating at 80-90% capacity. A lot of us have seen a salary cut. There are some places where job losses have started. So what is giving a borrower in this case, or let's say retail borrower, to start opting out of moratorium because the cash flow situation has not increased?
Thanks for the opportunity. Let me break this up into 3 to 4 bits which will add up to what we're eventually seeing on currently. So one big change in terms of take up to moratorium that we've already seen has been that the large corporates, which have actually opted for moratorium as of April, now quickly realizing they've reassessed their cash flow situation, probably would have raised some funding. And so it makes sense for a lot of these large corporates to get back to normalcy. So you've seen a sharp drop there. Secondly, the salaried segment, while there have been salary cuts and income loss to a certain extent, we've not yet seen job losses to the extent that would warrant a material revision to our thesis on the salaried asset quality. And so to that extent, you've seen the salaried segment also behave the way they should, and hence a material reduction in terms of moratorium there. And quite interestingly, at the bottom of the pyramid on the MFI side, again, compared to the 100% number that we've seen as of April, the moratorium levels have come down to 40%. Although, mind you, the way the accounting and the way the presentation of this number states is this is only on an incremental basis. So as long as a borrower pays one extra EMI or starts to shows the intention to pay an EMI, probably there is an element there. The banks are probably taking them away from what they're characterizing as moratorium. Where there has probably not been such a material improvement is what you're probably referring to is in the self-employed segment and the MSME space, where the strain is cash flow situations continue to remain weak. Leverage, obviously, at a time where the demand is collapsed, is going to create a huge mismatch in terms of the ability to service. And hence, there the reduction is low. And so when you then look at what the banks have reported, for example, HDFC Bank is primarily a salaried lender. And even in the case of SBI cards, 85% of their borrowers are salaried in nature. And hence, this mix of higher salaried versus self-employed is what's leading to the reduction in moratorium. Now, having said that, I would say these are all incremental trends which have been anticipated, I would say, to a large extent by market. And what is probably the most critical element to all this is where would this moratorium number stabilize by the end of August? Because whatever that residual piece is would have a very high probability of default and would create the incremental credit costs going into the remainder of the year and probably FY22. And hence, while the trends will always get better as the lockdown eases, as people get out from a panicky reaction to a more objective assessment of moratorium, the fact of the matter is the end game is primarily in terms of what is the residual piece at the end of August.
Okay, right. Mr. Mehta, the other issue is that banks right now are requesting RBI to consider a one-time restructuring. If a one-time restructuring, let's say, is not announced, what could be the implications of that on corporates and especially on the SME front?
Well, as I rightly told to you that yes, corporate sector, the moratorium which has been asked by the existing corporate is only to the tune of 15%. Some of the sectors which are really have a major hit in this period is basically aviation, hospitality, to travel and tourism, hotel and restaurants. So a lot of segments have seriously got impacted during this pandemic. And in my, as far as IBA thinking goes and the banker thinking goes, restructuring for them will be absolutely necessary for them to sustain, because whatever overhead costs they have incurred during this period of 8 to 10 months, and the normalcy may not even come back in 12 months. So they will require a long-time restructuring, because just giving moratorium will not suffice. Because the moment the moratorium is over, that all new demand comes back, and they may not be having adequate cash flow to take care of it. Then for MSME segment, fortunately, there is one very positive thing which has happened. That is, government has come out with a 3 lakh crore of emergency line of credit for the smaller and the middle segment, which is having an outstanding exposure of up to 25 crore. So that segment is now getting an incremental 20% guaranteed line of credit, which will help them in sustain during this time. and that will give them the time to bounce back also. So the chances of delinquencies in MSME space has come down after introduction of emergency line of credit in form of 10% COVID line given by the banks, then 20% emergency line of credit, guaranteed line of credit given as per the government initiation. So this is going to provide them some breathing as well as the sustenance during this difficult time. But MSME space, I think you are already pretty well aware that RBI has permitted restructuring window up to December 2020. So that window is already available. So there can be three types of cases. One type of cases where the stress is very low, especially in the food industries and the processing industry. They may not require any moratorium. They may not require any restructuring. They will continue as healthy. Then there will be some type of activities where there is a very small stress that can be addressed by this emergency line of credit, where a 20% incremental fund-based limit is given with a moratorium of 12 months and then repayment period of another 3 years. So that can be addressed through that. Then there is a third segment which were already into stress and got greatly impacted because of this COVID. So that is one area which can be addressed in two particular ways. One is there is a 20,000 crore of the subordinate debt scheme which has been announced by the government of India. So they may not have the position to inject the capital. So whenever their working capital requirements are reassessed, at least their contribution in the form of the margin can from this subordinate debt facility, which is being now offered by the bank and which is guaranteed by the ECGC. So that is being guaranteed by the CGTMSE. So that is one thing which is already there. Now fourth segment is, yes, there will be those who do not get any of these benefit. Then of course the stress will have a spill and we can see some increase in NPLs in that segment. But the quantum which we were earlier anticipating have a major hit in MSME will be now reduced down to very smaller segment, maybe 15-20%, which will be out of all these three schemes and which may not get coverage into these areas. As regards large corporates, as I rightly said, those who are into the hospitality, those who are into these specific segments, if they do not get relief, then the chances of delinquencies will definitely be great. And I hope the regulator will accede to the IBA's request and may come out with restructuring for these areas.
Sure. Sri Kartik, if I could, just talk about what the market is pricing in right now. Because if you look at HDFC Bank, the valuation seems to have recovered considerably organically without any fundraising activity. Why don't other banks wait for a recovery in their market price before they actually conduct such big fundraisers? I mean, is it because there is a big institutional appetite right now, or is there a sense of urgency on behalf of the anticipated stress that these banks may be faced with?
So on that aspect, one needs to consider how much, what is the quantum that is necessary, and more importantly, if you notice the commentary coming in from some of the CEOs and some of the promoters of the larger banks, the clear message is to raise capital when the money is available. And so timing is always going to be very subjective on the part of the individual bank. And I guess the thought processes before the moratorium and the real reality on the balance sheets is becomes probably more apparent starting Q3 onwards. There is a brief window which the market is presenting for a lot of these lenders to take advantage of. And looks like most of them are looking to time it before the real news with respect to the residual stress and the real asset quality numbers start to be visible from Q3 results onwards. So it's more to do with accounting leeway which moratorium presents at this point of time.
Sure. Mr. Mehta, on the subject of mergers or privatization of the remaining PSU banks, what are your own thoughts on whether or not this can really rescue the situation at hand?
I think this is just a thought process which is being discussed in the media, which is being discussed about into the various stakeholders. Nothing on this account has already been freezed. But the various options, because government is thinking what are the can be the various way forward, whether privatization will be a better option or the next round of merger can be a better option. So this is just a brainstorming which is going on right now in the market, and is very premature to say anything what is going to make. But I think this will mainly depend upon the success of already existing mergers. So success of already mergers will be pronounced in some time because the merger process started in 31st March. And from 1st April, they started operating. Unfortunately, this time went into because of the pandemic. So a lot of activities could not happen, and only integration processes are going on. But its real synergy and impact will be seen after this entire process is complete and the economy bounce back to the normalcy. Once this experiment succeeds, the government may think of going for a next round of mergers for the remaining banks. But if they think that yes, this was not okay and this was not a very good arrangement, and then they may think of the second route, that's a privatization. But this is still a matter under brainstorming, and nothing has been freezed on this so far.
I'm guessing you would have a better grip on how these mergers have panned out so far while we still await the official numbers. Do you think privatization or mergers of PSU banks are a prudent option and a viable one at that?
Three basic reasons. One thing is, the entire banking landscape is going for a transformation, a great transformation. Earlier, there was basically concepts of brick and mortar branches, and all deliveries of the banking products were physical mode. People will go to the bank for obtaining an FDR, for depositing the money, and for all type of activities for a purchase of a draft. Gradually, the model became phygital, where basically part of the activities, especially into the payment started happening digitally, using of internet, making payments through card, and that ratio is still, although it is growing, but not to the full extent so far, which is yet to catch up. The moment this entire space is digitalized, then the next phase will be digitalization of the loan verticals, like delivery of the loan products. So when that segment is also digitalized, the banks will have to undergo a lot of transformation in terms of their physical presence, in terms of their branch network, where they have 20 branches in one particular area. They may be good with only 5 or 6, and remaining they can relocate. The manpower they can relocate into the different areas like wealth management, into the area of marketing, into the area of newer type of services, counseling. So what I mean to say is the entire banking landscape is going for a transformation, and the merger will provide them the synergies. Because if 4 banks are merged and the 4 banks have got n number of branches at a one particular point of time, then at least they can be reduced easily, because they are almost in the geographical proximity. So there will not be any customer inconvenience for those who are going for physical transaction, and it will save a lot of cost on establishment costs in terms of rent, electricity, as well as the manpower redistribution. This will also provide a scope to the merged entities in expanding to the newer areas, because everywhere there are some new colonies are coming up, new real estate is being built up, there may be new industrial areas being built up. So whatsoever manpower, whatsoever resources can unlock from this type of synergy, that can be redeployed into these areas and more specialized new areas. So I think it is a very welcome move. It's a very right and timely move. Besides providing them the strength, balance sheet strength for taking larger decisions, this will provide them operational synergies also. Another major area where this will help is, earlier for funding a single project, there used to be 15, 20, 30 lenders coming together to fund a common project. And 30 lenders to take a decision simultaneously is regularly become a Herculean task. Sometimes the time gap between the first decision making and the last decision making is as long as 10 months or 1 year. So that really defeats the basic purpose and the objectivity of taking that decision. So with the reduction in number and the increasing in the size of these banks, they can take a larger share of the total project. So maybe maybe the total number of consortium member can be restricted to 10. So where each member is having a share of roughly 10% or little more than that, and that will really be facilitate the quicker decision making, which will be in the larger interest of the all the stakeholders in the economy. The corporates will get advantage of a faster decision making. The banks will be able to take quicker decisions and prevent the stress wherever is necessary or appropriate realization of the value. So delay in decision making will also be reduced, and that will also help the entire banking system. So I think this merger is going to, if the way it goes forward, and if the banks are able to take benefit of the synergy, it can be really advantageous to the entire banking system. And internationally also they will have a larger balance sheet too, so that the international exposures they can take in a better way, because they will have a more diversified portfolio as well as a stronger base.
Sure. Mr. Mehta, Sri Kartik, thank you both of you for taking time out, and Mr. Mehta especially for giving us perspective on whether or not PSU disinvestment or PSU bank disinvestment and privatization and mergers actually make sense going forward or not. We were really seeking that clarity. Good to have you both on the show.